Hey, hi, it's 9 o'clock here, so 7 o'clock in London. I'm going to start the webinar now. Thank you all for joining. My name is Sari Holtz, and I will now be talking about Forex versus stock trading. Which one is right for you? A bit of an introduction about me. My name is Sari Holtz. I am a partner manager and market analyst at dailyforex.com, a website that focuses on providing investment advice, mostly about currencies, which is also called Forex, which is short for foreign exchange, and also some stock tips and commodities tips, gold, oil, all sorts of other assets, which we won't be covering today, also Bitcoin, other type of crypto assets. Please feel free to check out our website and learn more if you're interested in any of those type of assets. Possibly we'll cover them in future webinars. My personal area of expertise, I guess you could say, is stocks, but I'm also quite well versed in Forex since I've been working here for 11 years. And today we're going to look at the difference of both of those assets and see which one of them is right for you. In addition to my work here, I'm also a mom of 5, and I like spinning and other types of entertainment, so I've got a pretty full plate, and I'm going to talk a little bit about how trading can fit into your lifestyle, no matter what type of job you have and what type of hobbies you like to pursue. A short risk disclaimer that Daily Forex and our parent company, Global On Media, are not liable for any losses, financial or otherwise, that you might incur from the trading tips or suggestions provided in this webinar. I will not be providing any actual trading suggestions. I will just be talking about overarching ideas about different types of assets and possibly giving ideas for you to consider and possibly trade in the future. But this is not a market analysis website. Okay, so let's start by looking at the differences between the Forex and stock markets just on a purely comparative plane. The Forex market, which I said earlier is the currency market, is the most liquid market in the world. It has a $6 trillion daily average of trades. And that means that any trade that you put in, you'll find someone to take a counter trade, and you'll be able to get pretty much the price that you want. Every once in a while, if there's high volatility or low volatility, you won't. But for the most part, you'll be able to get the price that's quoted on your brokerage platform. In contrast, in the stock market, there's only $200 billion of daily trading, which is still quite impressive. It's done on different stock markets. We have the CAC in France, we have the FTSE, we have the NASDAQ, the New York Stock Exchange. Each asset, each specific tradable stock is traded on its own platform. And some stocks, of course, are cross-listed. The Forex market is less volatile than the stock market, which means that it's less likely to move in very significant ways based on a specific news analysis. For example, the Delta variant or the Omicron variant of Corona had strong reverberations in the stock market, and they were significantly less in the Forex market. Just as a side point, it also impacts, obviously, the oil market is significantly correlated to the news, but Forex less so, still, but less so. In contrast, the stock markets, which don't move necessarily as much as Forex in a day, are highly volatile, and they can move in significant percentages based on news and other things that go on in the world. Corona is a good example. A presidential election in a significant country such as Germany, France, UK, prime ministerial election, the US, of course, all of those things have a tendency to add volatility to the stock markets. Inflation is another good example of something that can move the stock markets and make it highly volatile. The third thing that's worth considering is that the Forex market is available 24 hours a day, which can be a huge advantage based on your lifestyle and your work schedule and all those things, which we'll talk about in a few minutes. Whereas the stock markets are open for only 8 hours, depending on where you live. So if you live in New York, it's open from 9:30 to about 4 o'clock in the afternoon. If you live in London, the same, but it's only an 8-hour window no matter where you live. So, and you're going to be trading probably on the exchange in the area where you live for the most part. The Forex market has a fairly narrow focus. There are many, many currencies and many, many currency pairs, about 300 different currency pairs, but only 8 of them are considered major pairs, which would be with assets that are, we could call them popular assets. So for example, the euro US dollar is the most popular asset. Everybody's heard of the euro, everybody's heard of the dollar. So when people are going to trade currencies, they're most likely to be trading, if not one of those currencies, then both of them. The same thing for the Australian dollar and the US dollar, or the Canadian dollar and the US dollar, or the British pound and the US dollar and the yen. So there is a certain basket of major currencies, and then we have cross pairs such as the Turkish lira, or South African rand, or the Indian rupee, or the ruble, or the zloty. You can trade any of those currencies against any other currency. It's just significantly less popular, and they may not move in any direction as quickly as the major pair. In contrast, the stock market has literally thousands, if not tens of thousands of assets. So you've got your Microsoft and your Amazon and your Apple. Those are the main, things like that that are extremely popular. Intel and Cisco and Tesla, things that, everybody basically has heard of. And then you've got, really tiny stocks, even penny stocks, that maybe other people haven't heard of, but you can still trade them and you can still profit. Many of them still have dividends and other benefits that you might want to trade, but they're just lesser known. So I guess the question, if you're looking at whether you should trade currencies or stocks, is if you want to trade a ton of things, or if you want to just stick to what you know. Is 8 enough? Do you have specific goals? And we'll talk about that in a few minutes. But the variability between Forex and stocks is huge. So you should think about that as either an asset, as a benefit for you if you like to diversify, or as a drawback if you like to go with what you know. As my grandmother likes to say, it's always good to go with what you know, and stay, in more comfortable assets. The next thing to consider is the commissions that you're going to have when you're trading either currencies or stocks. In currencies, in the Forex market, the commissions tend to be lower than they are in the stock market. So you have to consider how much you're putting in, what you think you're going to earn, and what a good percentage would be to pay in commissions. I strongly recommend that you check the commissions carefully before you trade so that you'll know. It happens to be that in today's day and age, many stockbrokers now charge 0 commissions, but they're still making money on you. They're still taking it on the spread. So if something's $1, they may give you 95 cents, just as an example. Very similar process works in the Forex market though. So you have to be careful. You always have to remember that even if there is a claim of no commissions, your broker is still making money on you. You just might not feel it, especially if you're in the green. So that's very important to consider. It's not the only thing to consider, by the way, and maybe we'll talk about that in another webinar, how to choose the right broker, either a stock broker or a Forex broker. There are certain things you're going to want to look for. Fees are important, but they're not the only thing that's important. The same way when you buy a car, the price, of course, is important, but you're also looking at safety, and you're also looking at reliability, and, you know, how the parts are going to hold up, and you know, possibly even how it looks could be an important factor. There's lots of things to consider, and not just the sticker price. So don't be scared by commissions or by spreads. Just keep it in mind that you should always try to get the best ones with a broker that meets the rest of your needs. And the last thing that I just want to touch upon is the liquidity. Like we said, because there's a higher trading volume in the Forex market, there's higher liquidity, whereas the stock market has lower liquidity. It's happened to me a couple of times where I've put a trade in and I couldn't actually get the stock at exactly the price that I want to. Sometimes that works out to my advantage, and sometimes that doesn't. I mean, it's a couple of dollars here or there, just really interesting, especially on a trade I put in, you know, a couple of months ago for Target, which is a huge chain store in America, that I couldn't get all of the shares that I wanted at one time. And it was only like 50 shares, you know, it's not like a tremendous amount. And the brokerage broke it down to like, you know, 35 and 15 within seconds of each other, but that's just because of the liquidity. So now that we've discussed a little bit about the advantages and disadvantages and the differences of both types of trading, I want to talk about your specific needs. Choosing an asset to trade is a lot like going to a restaurant and choosing food that you want. It depends a lot on your preferences, what you like, what you don't like. Are you hungry for a steak, or are you not so hungry and you'll take the salad? You know, these type of things are important. And when it comes to trading, your preferences can change over time, as they do with your meals. So you have to think about it carefully and possibly regularly to see if what you're trading is still meeting your goals as they develop over time. So the first one is availability. What time zone are you in? Are you looking to trade, you know, at night after work? And what time is after work where you are compared to where the stock markets are? You know, let's say if you're in South Africa and you're looking to trade US based stock trading, it might be when it's the nighttime for you. Maybe you're with your kids, or maybe you're tired after a day of work. So maybe stocks will be difficult, but the Forex market is available any time of day. So you can trade before work, on your lunch break, whatever. On the other hand, maybe you're only looking to trade after work. If you live in America, trading stocks may be difficult because you'll also always be trading off hours if you can't do it during your work day. So you have to really think about when am I available and what assets are available at the time that I want to be trading. The Forex market is open 24/5. So it's open from Sunday till Friday night at midnight. And the stock markets are not open on Saturdays or Sundays. And they're also closed, like I said, every night. And some brokers also, by the way, charge rollover fees if you hold your asset overnight. So, you know, you have to think about that if you're trading in off hours. The second thing to consider are your financial goals. Are you looking to make a lot of money or a little bit amount of money just to supplement your income? Is this going to be a full-time thing for you? Different assets trade differently. For example, you know, I'll just give you an example of a trade that I made. I put a trade in Microsoft in 2015, and it's 400% higher now than it was in 2015, which is amazing, except that I had to wait 6 years for it. Okay, but if you're not in a rush, then it doesn't matter which time ties directly into your time frame, by the way. If you need the money right away, you'll see much more movement in the Forex market, than in the stock market. You can possibly reach your financial goals faster. In the Forex market, you are also potentially more vulnerable to losses because things tend to move much more quickly than the stock market, and you could tend to lose money faster. So You just need to think about that as well. Okay. The next thing to consider is your risk appetite. How do you feel about putting your money at risk? Do you want to put your money at risk? Are you willing to take a loss, or you can't afford a loss? The first thing I would argue, or not argue, but be very firm about, is never trade money that you can't afford to lose, okay? Because no matter what asset you trade, there's always a chance that you could lose money, especially these days. For example, the market, both the currency market and the stock market, but the stock market more, is extremely vulnerable to changes based on the corona climate. So whereas last week we saw huge gains, this week not so much, and we're seeing huge losses. If you're in it for the long run, inevitably you'll make money eventually. But if you're placing a trade on a short time frame, such as in the Forex market, you have to consider that you're looking at things in a different way, and it depends all on your risk appetite. Okay. It's also really important to consider the leverage that you want to trade with, and leverage can be a huge advantage. Imagine if you only have $100, but you can trade with $1,000 worth of money. That's how leverage works. And it's actually really quite amazing, because you could make 10 times your money in a short amount of time. This almost exclusively works in the Forex market. But of course, if you're using leverage 10 times your money or 100 times your money, some brokers even offer up to 1,000 times the leverage, you may also suffer losses. And if you lose money, if your trade goes south, then you could lose more money than you have. Many brokers offer protection against this, but it's also something to consider that it's dangerous and you should use it with caution. A lot of traders think, oh, well, if I have 1 to 1,000 leverage, then I'll really be able to maximize my money. And this could be true, but it's also extremely risky, and you should use it with caution. A really interesting thing to consider is placing long and short trades, which is not something that most people do in the stock market, although it is possible with options. I'm not an expert in options, but you can definitely read up more about that. There are a lot of experts talk about it a lot. We have some articles about it on our website, dailyforex.com. But in the Forex market, it's extremely common. What does long and short mean? If you're going long, it means that you think the price of your asset will go up over the course of time. So for example, in the stock market, I would say, I think the price of Microsoft is going to go up over time. If it's in the Forex market, you could say, I think the price of the dollar is going to go up against the euro over time, or I think the price of the euro will go up against the dollar. In a contrast, you could also say, I think the price of the pound is going to go down against the dollar. That would be placing a short trade. And when you do this in the Forex market, you can also make money if the trade goes the way you think it will, even if the asset is not going up. So if you think that the pound is going to go down against the dollar and you put in that trade and the pound does go down, you still hit your target and you can still make money. This is a huge advantage if you think that you understand the currency markets enough to do that. And again, we have tons of articles about this on our site and different strategies that you can use to determine which way an asset is going to go. It's not a guessing game. It's not a game at all. Serious traders will do a lot of research. They can practice their trades on a demo platform before they invest real money. So don't be afraid to cultivate ideas and to build a strategy and to try it out, long or short, if you're a Forex trader, or if you're a stock trader, but with more limitations, and see how that goes. Just know that if you want to bet against the market, Forex is probably a more likely option for you. Let's talk about your minimum deposit. This is a huge issue, especially for women. Everyone's always afraid of putting in too much or putting in too little. There's no real right answer. Of course, it depends entirely on your personal financial situation. I myself have a small amount of money that I withdraw straight automatically each month from my checking account. It goes straight into my investment account. It's not a huge amount. And when I have more money, I put in more money. But when it comes to Forex, most brokers accept a minimum of $100 to open an account, which, you know, for most investors is not a lot of money at all. It may seem like that right now, and if it does, then you may want to wait until you have a little bit of more available capital before you start trading. But stockbrokers often have higher minimum deposits. It might be $1,000. You don't have to put all of that $1,000 into one asset necessarily, but it will have a higher minimum deposit in order to get started. So consider that when you're thinking about the assets, how much do you have to trade and how much can you play around with? And I use the term play extremely loosely because I do not see trading or investing as any type of game. I see it as a really serious way to make money or make extra money, but it needs to be done thoughtfully and not as a get-rich-quick scheme. Okay. Also, it's important to note that even if a broker has a minimum deposit of only $100, you probably need more than $100 to really get the knack for trading. If you have $100, for example, you might be able to buy one stock or a fractional share of a stock. It's not really enough to get your feet wet and see how it goes. And if you lose it, for sure not. So consider the minimum deposit carefully, because even if it's low, you probably need a little bit more. As a general rule, we recommend $500 to really start trading, but you can obviously trade with less. Okay. We talked about this before, but I just wanted to put in a bit of perspective. In the Forex market, there are 300 pairs, of which only 8 of them are majors. So we've got the typical euro, the pound, and the dollar. We have the dollar here also represents the Australian dollar, the Canadian dollar. We've got the Hong Kong dollar. We've got the Swiss franc. And you could literally trade anything like the Swiss franc against the Indian rand, you know, a baht against the rupee. But these pairs they're called exotic because they are exotic, much like their home countries. Most people are not trading them. They may not move around a lot. And you really have to know what you're doing. So you have to be careful. And also most analysts don't cover those very small pairs. On Daily Forex, we cover a lot of popular exotic pairs. For example, we cover the rupee a lot. We cover the rand a lot because those are becoming more popular in today's day and age. We cover the lira, but we're not covering them all every day because sometimes they're not moving so much. In the stock market, it's not quite the same. There are analysts that can cover almost any type of stock at any time, and you can read reports about literally thousands and thousands of stocks, some of which you may have heard of. Again, I've got Microsoft, Apple, and Amazon here. We have, you know, the typical FANG stocks, Facebook, which is now Meta, and Amazon, Apple, Netflix, Google, Alphabet. Those are typical companies that everybody knows. But in your country where you live, there may also be other local stocks that may be of interest to you and that you'll be able to read analysis about from reputable sources. For example, the grocery store where you live. Like if you live in the UK, for example, which I do not, you could trade Tesco. I don't know anything about Tesco because I don't live in the UK, but you can easily relate to these type of stocks in a way that you might not relate to exotic Forex pairs. And Tesco isn't like necessarily one of the biggest stocks in the UK, but it's well known enough that people will know about it. Okay. So I think we've given a good picture about what type of assets are good for which type of people. And based on your needs, your time zone, your financial goals, and all of those type of things, I think you should be getting a good picture in your mind of which asset is better for you. By the way, I may have forgotten to mention, of course, you can trade both stocks and Forex. You can try each, see which one feels better to you, see which one, whether you like the fast pace of Forex or the slow pace of stocks. Any of those things are fine. You can do them both. And most brokers offer a combination of both assets, so you shouldn't have a problem. The same goes, by the way, for cryptos and commodities. You can trade wheat, corn, all of those things. Anything is possible. This is beyond the scope of this webinar. But if you choose the right broker, that's definitely something to consider to see what assets they offer. And I would strongly encourage you to look for a broker that offers a wide enough range of assets in both family classes so that you can have your choice at any time. Okay. The win rate this is perhaps the most important part of this whole webinar. The win rate, which of course everybody wants to be a profitable winning trader. The win rate for day traders is only 10%. That means that most day traders actually lose money. It could be that your wins outweigh the losses, but it's so important to consider that people who are doing day trading are not rolling in the dough every day. A lot of times placing more trades causes people to make mistakes, and then that affects their win rate and they end up losing money. But if you are invested in stocks for the long run, the average annual return of the S&P 500 is 7%. So it's safe to assume that if you invest in the S&P 500 for the long run, you will make money in the long run. Now, the S&P 500 has a losing year every couple of years, but for the most part, it has an annual return of 7%. So if you're playing a long game, it's certainly safer to be in it for the long run than to be in it on a daily basis. Of course, if you have short-term financial goals, Forex may be a way better option for you. I just want to touch on a point that I made in my last webinar last month. For those of you who didn't attend, I strongly encourage you to check it out on the Daily Forex website. When we talked about the strength of women in trading, I know a lot of the people who registered for this webinar are also women, and it's really important for me to point out that women have a higher percentage rate of wins than their male counterparts. So the reason for this, again, that we talked about last time, is because women tend to place less trades than men. That's true both in Forex and in stock trading. Women tend to be more methodical. They think things out more clearly, and they're more willing to wait for their trade to be positive and to be in the green than to just sell it on a whim if it's losing, or to sell it prematurely. Even if it's winning, a woman might hang on to it longer than a man and make more money. This is important to consider because it will give you an overall view of how your trading strategy will go over time. And don't feel that you need to be a day trader, that you need to make 1 million trades in a day. You can make 1 trade a day, or 2 trades a day, or 2 trades a week. And that could be more profitable than making 10 trades a day, but they're not the right trades. So feel your power. Don't be afraid to listen to your gut and take things slow, and that's okay. And in fact, it's better than okay. I think that you will eventually own it. You'll feel the confidence once you start getting those wins in, and you'll know what the next right move is. So don't feel pressured to make more trades. Like we see, those who make more trades are less profitable than those who make less. That applies to both men and women. But take your inner power, harness it, and I'm confident and hopeful that you will find your financial success from whatever type of trading you choose. That's all for today. Feel free to check out other webinars. We cover tons of great topics on Daily Forex. We also have articles We have emails. We provide trading signals for people who want to see an expert opinion on the day's market and where the markets are heading. We've got tons of services. I hope that you will join us for future webinars. Please feel free to reach out to me with any questions. And I look forward to seeing you again soon.